Building wealth doesn't have to mean taking big risks. In fact, the most successful wealth builders are often the ones who played safe, strategically. Building wealth might seem like a complex game only for the wealthy or risk takers. But here's the truth. You don't need to take huge risks or make wild moves to grow your wealth. In fact, the most successful wealth builders focus on simple, smart, and steady steps over time. The key to success lies in how you approach your finances at different stages of life. The strategies you use in your 20s won't be the same as those in your 30s or 40s, and that's okay. Each decade offers unique opportunities to build a solid financial foundation, grow your assets, and secure your future. In this video, we're going to walk through exactly how you can build wealth in your 20s, 30s, and 40s without relying on high-risk investments or complex strategies. Chapter 1. Building Wealth in Your 20s. Your 20s are the perfect time to lay the groundwork for your financial future. It's not about getting rich overnight. It's about building habits that will pay off in the long run. Let's break down the most important steps to take in your 20s to start building real wealth. Establishing a strong financial foundation. The first step is to live below your means. As you begin earning more, avoid the temptation to spend more. Instead, focus on saving. Aim to put aside at least 20% of your income. Track your expenses with apps or a simple spreadsheet to make sure you're spending less than you earn. Building a budget early on ensures that saving and investing becomes automatic parts of your life. Paying off high-interest debt. Debt, especially credit card debt, can be a major obstacle to building wealth. In your 20s, the average credit card debt is between $22,000 and $33,000, with interest rates often reaching 18% annually. This can drain your finances. Focus on paying off any high-interest debts quickly. Use the debt snowball method, paying off smaller debts first for momentum, or the debt avalanche method, tackling the highest interest debt first. Both approaches help you reduce debt and free up money for saving and investing. Investing early for compound growth. The earlier you start investing, the more your money can grow. Even small contributions to retirement accounts like a 401k or IRA can make a huge difference over time. If your employer offers a 401k match, take full advantage of it. This is essentially free money. By starting early, you can take advantage of compound interest, which means your investments grow exponentially over time. For example, saving just $100 a month from age 25 could grow to over $100,000 by retirement, assuming a steady return. Building an emergency fund and credit score. Another key step in your 20s is to build an emergency fund. Set aside 3 to 6 months of living expenses in a high-yield savings account. This will help you avoid going into debt when unexpected expenses arise. Additionally, start working on building your credit. A strong credit score will help you secure better loan rates in the future, saving you money when it's time to buy a car or a home. By focusing on these 4 key areas, living below your means, paying off high-interest debt, investing early, and building a safety net, you'll set yourself up for long-term financial success. The decisions you make now will lay the foundation for your wealth in your 30s, 40s, and beyond. Chapter 2. Expanding your wealth in your 30s. Your 30s are when your financial situation should start to feel more stable. And now it's time to shift gears. You've laid the foundation, and the focus in this decade is on expanding your wealth. It's about boosting your savings, diversifying your income, and keeping lifestyle inflation in check. Let's explore the key strategies. Accelerating investments and savings. In your 30s, you need to ramp up your retirement contributions. At this point, aim to save at least 15% of your income for retirement, including any employer match. The more you save now, the more you'll benefit from compound growth over the decades. If you're not maxing out your 401k or IRA, start doing so. These accounts offer tax advantages that will help your money grow faster. One of the most powerful ways to build wealth is by automating your savings. Set up your automatic contributions to your retirement accounts and investment funds so that you're saving consistently. As your income increases in your 30s, resist the urge to spend more. Instead, boost your savings rate and invest the extra money. Even if you can only invest a little more each year, it'll add up over time. Diversifying income streams. In your 30s, it's smart to have more than one source of income. Many millionaires have multiple income streams, so why not follow suit? Look for side hustles, freelance work, or ways to turn hobbies into money-making opportunities. Whether it's freelance writing, graphic design, or driving for a rideshare company, additional income can fast-track your wealth building. Real estate is another great option. While you may not have enough capital to buy properties outright, you can invest in real estate investment trusts or REITs, or look into house hacking, where you rent out part of your home to cover your mortgage. Real estate tends to appreciate over time and can provide steady cash flow through rental income. Avoiding lifestyle inflation. As your career progresses and your salary increases, there is a natural tendency to increase your spending. This is what we call lifestyle inflation. But here's the secret. The wealthiest people avoid it. Instead of upgrading your lifestyle to match your paycheck, keep your spending habits in check and use the extra income to increase your savings or investments. For example, if you get a raise or bonus, avoid the temptation to buy a new car or take an expensive vacation. Instead, consider investing the extra funds or putting them into a high-yield savings account. The more you save, the faster you'll build wealth. Smart risk management. In your 30s, it's important to strike a balance between growth and security in your investment portfolio. While you can still afford to take on more risk than someone in their 40s or 50s, it's crucial to manage it wisely. A good strategy is to allocate about 80% of your portfolio to stocks for growth and 20% to more stable investments, like bonds. If you're still heavily invested in high-risk assets, it might be time to start diversifying. Real estate, index funds, or bonds can help protect you from market downturns while still allowing your wealth to grow. Regularly review your portfolio to ensure your investments align with your goals and risk tolerance. Chapter 3. Securing Wealth in Your 40s. By your 40s, you should be well on your way to building wealth. This is the decade to focus on securing what you've already built, fine-tuning your retirement plans, and reducing financial risks. The focus shifts to maximizing savings, minimizing taxes, and ensuring your financial future is solid. Maximizing retirement contributions. In your 40s, you should aim to have 3 times your annual salary saved for retirement. If you haven't reached that goal yet, it's time to catch up. Maximize contributions to your retirement accounts, 401k, IRA, or Roth IRA. For 2024, you can contribute up to $22,500 annually to your 401k, with a catch-up contribution of an additional $7,500 if you're 50 or older. These contributions are tax-deferred, so they help you reduce your taxable income while growing your wealth for retirement. Focus on automating your contributions to make saving easier. You can also start considering other savings options, like health savings accounts or HSAs, which offer triple tax benefits and can be used for medical expenses in retirement. Tax optimization strategies. As your income grows, so do your taxes. In your 40s, consider strategies to reduce your tax burden. Start by maxing out tax-deferred retirement accounts. The more you contribute to your 401k and IRA, the lower your taxable income. Additionally, if you're self-employed or own rental property, make sure to take advantage of business-related tax deductions. You can also explore more advanced strategies like tax loss harvesting, which involves selling losing investments to offset capital gains tax. Speaking to a tax professional can help you identify other strategies to keep more of your money. Mortgage and debt management. In your 40s, focus on reducing or eliminating high-interest debt. If you have a mortgage, consider paying it off early if possible. While it may seem tempting to keep a low-interest mortgage, paying it off early can free up cash flow and provide peace of mind as you approach retirement. The average millionaire pays off their mortgage in just over 10 years. If you can't pay off your mortgage early, try to make extra payments toward the principal to reduce the amount of interest you pay over time. Planning for children's expenses. If you have children, your 40s are the time to start planning for their education. Open a 529 plan or education savings account or ESA to save for their college expenses. These accounts grow tax-free, and the money can be withdrawn for educational costs without penalties. As we conclude this video, remember, it's never too late to start. Whether you're in your 20s, 30s, or 40s, small steps today lead to big rewards tomorrow. Stay focused on your goals, and you'll be well on your way to financial freedom. If you found this video helpful, don't forget to subscribe for more practical tips on building wealth and securing your future. Thanks for watching.